the FOMO is not about Bitcoin. It's about buying gold. And so you're going to see that, but you're also going to see private investor demand, I think, in 2026, like we've never seen, because people are going to look back at 2025 in early 2026 at the spectacular returns in gold relative to equities, relative to crypto, right? Relative to everything. And people are going to get invested. And again, Morgan Stanley came out and said, we need to adjust the 60-40 portfolio. We're going to cut the bond allocation in half and replace it with gold.
Gold's dominance in 2025 has not been a temporary rally or a speculative surge. It has been a structural repricing of the world's oldest monetary asset. For the first time in decades, gold has behaved exactly as a reserve asset should, rising sharply in an environment where every other major asset class faltered. With year-to-date performance exceeding 50%, gold dramatically outperformed the S&P 500, the Nasdaq, global equities, bonds, and especially cryptocurrencies. And despite the volatility across global markets, gold held firm as investors sought something that could absorb both liquidity shocks and monetary mismanagement. This is the foundational shift Peter Schiff is now highlighting. Gold is not merely rising, it is reclaiming the role that central banks, institutions, and even retail investors had temporarily abandoned in favor of digital narratives. Silver has also stepped into a new paradigm. Rather than lag behind gold, as it did for most of the 2000s and 10s, silver has now begun to reflect the full extent of monetary risk embedded in the global system. With the metal testing multi-decade highs around $50, its performance is no longer the product of speculative enthusiasm, but a signal that industrial demand, investment flows, and structural supply deficits are converging. This dynamic mirrors what Schiff warns will intensify in 2026. A historic surge in private investor demand as the world digests just how dominant gold was throughout 2025. Investors who ignored metals are now confronting a reality in which gold dramatically outperformed equities, crushed the crypto complex, and delivered returns that bonds, especially treasuries, could not come close to matching. All of this creates a market environment that is not speculative, but deeply structural. The repricing of risk, the global shift out of sovereign debt, and the consistent bid from central banks have built a foundation that supports further upside. Schiff's core message is simple yet powerful. Gold has resumed its historic function as the only universally accepted reserve asset, and silver, always more volatile, is positioned to reflect that recalibration even more aggressively. The investors who recognize this shift early are the ones who stand to benefit most as 2026 approaches. In a moment, you'll hear Peter Schiff expand on these dynamics, from the liquidity squeeze that hit equities and precious metals, to the yen carry trade unraveling, to the extraordinary resilience of gold and silver amid global volatility. His breakdown goes far beyond price action. It reveals the underlying forces that will determine where capital flows next. And what he describes offers an important preview of why the metals market in 2026 could look nothing like the markets of the past decade. If you're serious about understanding the forces reshaping global finance, make sure you stay with us through the full analysis. And if you find value in deep, data-driven breakdowns of gold, silver, and macroeconomics, please hit the like button, subscribe, and turn on notifications so you never miss content like this.
But given this mass liquidation, which I think looks like it was liquidity driven, I think people are getting some margin calls. I think there's some forced selling. And that may have been why the gold stocks got hit so hard yesterday. Even though gold was not down very much, maybe less than $20, gold stocks were down 4% or so. In fact, that's how much they were down on the week about. The GDXJ were off about 4%. Pretty much all those losses being clocked yesterday. In fact, we made up some of those losses today. So actually it was a bigger drop, or there were some losses earlier in the week. Silver was down over $1.50 in the early morning hours, got below the $50 level, came back up to about $50 late in the day. In fact, it did trade back above 50 intraday, but it looks like it's settled just below 50 I mean, I'm not sure the exact settlement yet because I'm recording this this pretty soon after the close, so I'm not sure where the settle is. But right now I'm looking at about a dime below 50, 49.90. But again, holding near $50, that's the breakout level. That's the old double top. So gold and silver holding up very well in the face of all of this market volatility. Part of it, though, is coming out of Japan. Part of the liquidity squeeze, the yen carry trade. The new Japanese government announced a massive new fiscal stimulus where they're going to be mailing out stimulus checks and doing some other stuff, right? And, these stimulus plans are all misguided. They've been making lots of mistakes in Japan, just like we make mistakes here. Although the Japanese stock market has been doing great, although all the other stock markets got clobbered last night as a result of this and what's been happening to Japanese government bonds. In fact, the 10-year JGB, the yield got above 1.8% yesterday. It backed off a bit today. I think we settled at about 1.77. But 1.8 was like a 20-year high. I forget exactly. But I've been talking on my main podcast at, the Peter Schiff, not on so much on the SchiffGold, although I probably mentioned it. But I've talked a lot about the yen carry trade and the blow up of the Japanese government bond market. And that's what's going on. Because when this started, the yield on 10-year Japanese government bonds was less than 50 basis points. And I remember when, they had a line in the sand there, they were trying to hold the yields below 50 basis points. In fact, they were quite a bit below at one point. And now they're more than triple that. I think once we get above 2% in the 10-year Japanese government bonds, you're going to see, some real fireworks in the markets, not just in Japan, but all around the world. But it was interesting because the government came out and said that even though they're doing this massive stimulus, they don't anticipate increasing the issuance of, Japanese government bonds. Well, how can that be, right? How are they going to run bigger deficits and not have to issue more bonds to finance them? And what I'm thinking could be the situation, and I don't know because the Japanese have been a bit reluctant to do this, but it's the smart move. Maybe instead of selling Japanese government bonds, issuing new ones, they'll just sell some U.S. treasuries because they've got over $1 trillion, right, losing value. The best way the Japanese can stimulate their economy is by selling treasuries, not JGBs. See, if they run bigger deficits, that's going to spook the bond market even more. That's going to weaken the yen. That's going to push up import prices. It's bad news. And the yen is already weak, near 160 against the dollar. They can solve their problems by selling treasuries and then selling the dollars they get when they sell treasuries to buy yen. And then they can send out that yen to Japanese citizens. And that's great because that'll strengthen the yen, which will give the Japanese more purchasing power, which will help bring down their import prices. And so that's the best way to stimulate the economy without hurting the economy. Because if they stimulate it by selling more Japanese government bonds, then you're going to weaken the yen. You're going to have more inflation. You're going to have more upward pressure on yields. So selling treasuries is great for Japan, but it's going to torpedo the U.S. economy and the U.S. financial markets because selling treasuries pushes up our yields, right? And it pushes down the dollar. And it also causes an unraveling, more so, of the yen carry trade, where people who borrowed yen to buy risk assets in the U.S. or even treasuries now have to reverse those trades, sell out their risk assets to buy back their yen. So some of that pressure may already be what was coming down on the U.S. tech stocks, and we'll see what happens next week as we continue and build on what happened this week, which again was a very significant week in the markets. But one of the reasons I think it was very significant for gold too is the blow up of Bitcoin, right? And because Bitcoin has been overshadowing gold for years, right? It's been stealing all the headlines, stealing all of gold's thunder. And I know it's been very frustrating to the gold bugs to just watch all the crypto bugs getting rich while, gold was going sideways. And in fact, it was, the years of sideways action. Gold peaked out from its big run from sub 300 in 1999 to 1900 in 2011. From 2011 to 2014, gold really didn't go anywhere because it didn't get above 2000 until 2014. And that was about the peak from 2011. So it was during, that, dozen-year time period where gold holders were frustrated by the failure of gold to make any, new gains, that Bitcoin was able to really steal the show by convincing a lot of people that it was the new gold. After all, look at this spectacular appreciation. Bitcoin keeps going up. Gold doesn't go anywhere, right? So Bitcoin is taking gold's place. It's better than gold. It's gold 2.0. And the markets kept, reinforcing this up until this year.
Schiff's observation about forced liquidations is a reminder of how leveraged this market environment has become. Even with gold down only a fraction during the sell-off, mining equities were heavily punished as margin calls rippled through the system. Silver briefly dipped below the $50 threshold before reclaiming that level, demonstrating that physical demand and long-term positioning remain strong despite short-term volatility. What's critical here is the divergence. The underlying metals held steady while paper market instruments absorbed the selling pressure. This pattern suggests that institutional deleveraging, not fundamental weakness, is driving the short-term turbulence. Schiff connects this to the broader liquidity crunch stemming from Japan, where rising JGB yields threaten to unwind one of the most powerful global funding mechanisms of the last 20 years. This sets the stage for the next major theme in Schiff's analysis: the knock-on effects of Japan potentially selling U.S. treasuries instead of expanding JGB issuance. Rising Japanese yields, fiscal stimulus financed through foreign reserve liquidation, and the unwinding of the yen carry trade all converge toward one outcome: a destabilization of U.S. bond markets and a rotation toward real assets. These dynamics reinforce why precious metals have remained resilient even in the face of broad-based selling pressure. The environment Schiff describes is not temporary. It is structural, and it forms the backdrop for his next argument about the accelerating collapse of Bitcoin, the rotation toward gold, and the institutional shift that is already underway.
So I think in 2026, you're going to see a lot of people that are going to be trying to rotate out of crypto into gold. Of course, there's not going to be much to rotate out of because the market's going to implode. So most of the money is just going to disappear, right? It went into the pockets of the people who sold the Bitcoin. They've been selling Bitcoin for years. The old OGs and the whales who got in at much lower prices years ago, they're the ones that benefited from the big run-up, not the people who have been buying it recently. But also, I think a lot of the institutional money that didn't even buy Bitcoin, one of the reasons they didn't get into the gold market was because they were hearing all this hype about how Bitcoin is going to replace gold. It's the new gold. And they probably thought, well, why should I buy gold? I mean, it's going to be replaced by Bitcoin. So even if they weren't buying Bitcoin, all of the Bitcoin hype may have discouraged them from buying gold. But gold is going to emerge as the winner. It's slow and steady wins the race, right? The tortoise versus the hare. Gold is going to emerge triumphant from 2025 with this huge performance as the air is coming out of the Bitcoin and the crypto bubble. I really think that there's only one hope that Bitcoiners have to stop this implosion, and that's a government bailout, a U.S. government bailout of Bitcoin. Now, of course, they wouldn't frame it that way. What they might do is Trump might come out and say, because of this big drop in Bitcoin, we're going to buy the dip. We're going to use this opportunity to fill up the strategic Bitcoin reserve, right? If the Bitcoin, lobby that bought and paid for the Trump campaign, if they can convince Donald Trump to buy this dip on behalf of taxpayers, right, which he's really just screwing the taxpayers over. But if the U.S. government, goes into the market and doesn't just buy Bitcoin, but indicates that it's going to buy a lot more, right, to get people excited about front running the trade. Absent that, I just think it's a one-way ticket down, and that's going to be great for gold. Of course, if the government has to bail out Bitcoin by using the strategic Bitcoin reserve, that proves that the whole concept is nonsense. Because if Bitcoin needs a bailout, then clearly it's not a reserve asset, right? If the government has to come to the rescue of Bitcoin, then how is Bitcoin going to rescue the government? Because that's the whole point of having all this Bitcoin. It's supposed to save us. We're supposed to make all this money on this Bitcoin. But if we have to prop it up and prevent it from collapsing, it reveals the truth. So it's going to be pretty hard to try to put lipstick on this pig and spin it as a good move for America to have a reserve of Bitcoin. But again, that's the only thing that I can see, because, a lot of the Bitcoiners think, look, this is no big deal. Bitcoin always drops and it always comes back, right? So we don't have to worry. We'll just hodl, right? We'll hold on for dear life. We'll ride it out, and it's going to make a new high, just like it always does. And of course, people have been conditioned to believe that, right? And it's going to work until it doesn't. And I know you're not supposed to say this time it's different, but this time it is different, I think. I think the leverage is much bigger than we've had in the past. We didn't have all these ETFs that I think you're going to see unloading. We didn't have them in prior cycles. In fact, they helped revive the market after the last downturn, all these Bitcoin ETFs that came on the scene and started buying up Bitcoin. And we also have all the Bitcoin treasury companies that we didn't have before that I think are going to become sellers of Bitcoin. So you have the treasury companies that are going to have to unload, the ETFs that are going to have massive reductions. You're going to have the margin liquidation from people who pledge their Bitcoin as collateral and then borrowed against it to buy stuff or pay their bills. They're going to be liquidated. And of course, what you have now that you haven't had in the past is this huge bull market in gold, right? If gold is performing this well, if you've got a 50% gain in gold, who the hell needs fool's gold? I mean, why would you have to give up real gold that's doing so well to take a chance on fool's gold, right? Before, the Bitcoiners were able to promote Bitcoin because gold wasn't going anywhere. But now gold is. Remember, they were saying Bitcoin is going to be the fastest horse in the race for the dollar debasement trade, for an inflation hedge. Well, it's getting killed. People in Bitcoin need a hedge, right? It's de-Bitcoinization, not just de-dollarization. People are getting out of that. And people are also getting out of tech. So I think everything is going right for the precious metals trade because all of the problems that it really was plagued by in the past are going away. And I think it's clear sailing. I think the central banks that have been buying gold all year are going to buy more next year. And a lot of central banks that haven't been buying gold, they're going to start because they can see how successful it's been with all the other central banks. You know, the Bitcoiners were saying that all the central banks were going to have to race to buy Bitcoin, right? That was going to be a Bitcoin arms race started by the U.S., but everyone was going to FOMO in to Bitcoin. It's not Bitcoin, it's gold, right? The central banks that have been buying gold are the winners. And in fact, now this year, the percentage of central bank reserves that are in gold is now higher than U.S. treasuries. And this is the first time that's been the case in a couple of decades. And so the central banks that already made the decision to buy gold, right, they're doing great. And I think that's going to result in bigger buys of gold by those banks. But now other central banks that weren't buying gold realize that they need to buy it because they're getting left out. The FOMO is not about Bitcoin. It's about buying gold. And so you're going to see that, but you're also going to see private investor demand, I think, in 2026 like we've never seen, because people are going to look back at 2025 in early 2026 at the spectacular returns in gold relative to equities, relative to crypto, right? Relative to everything. And people are going to get invested. And again, Morgan Stanley came out and said we need to adjust the 60-40 portfolio. We're going to cut the bond allocation in half and replace it with gold, which again shows they don't view gold as risky. Otherwise, they would have reduced their equity allocation. They reduced their bond allocation. They said sell half your treasuries. That's where the risk is. Get out of half your treasuries and put the money into gold. So this is a big deal. This is a game changer for the precious metal when it's finally being rightly understood for what it is.
Picking up from Schiff's final points, the picture he outlines for 2026 is dramatic, but firmly grounded in market behavior. He argues that the unwinding of Bitcoin's multi-year mania will coincide with gold emerging as the clear winner of the global flight to safety. The institutional money that hesitated to buy gold during the years of the digital gold narrative is now seeing gold behave exactly as a reserve asset should. Meanwhile, investors who entered crypto markets late in the cycle are discovering that the liquidity supporting those markets has evaporated. As Schiff notes, the whales who accumulated Bitcoin a decade ago have already exited. What remains is a fragile ecosystem dependent on leverage, ETF flows, and corporate treasuries whose risk tolerance is now diminishing. This shift is reinforced by central bank behavior. For the first time in decades, global central banks hold a larger percentage of their reserves in gold than in U.S. treasuries, a monumental rebalancing within official institutions. Central banks that aggressively bought gold in recent years have outperformed those that didn't, and that performance disparity is now pushing more countries toward metal accumulation. Schiff is essentially arguing that gold is transitioning from being a hedge to being a core reserve component, with sovereign balance sheets treating it more like baseline collateral than a speculative asset. At the same time, structural pressures in global bond markets continue to intensify. As yields rise and deficits expand, treasuries are no longer perceived as the unquestioned safe asset of the global system. Japan's potential move to sell U.S. treasuries to finance its fiscal programs underscores this vulnerability. Every percentage point increase in yields erodes the value of trillions in sovereign debt held worldwide, reinforcing the movement toward assets that cannot be printed, inflated away, or politically manipulated. Gold and silver are the natural beneficiaries of this realignment. All of these factors, central bank accumulation, collapsing confidence in Bitcoin, sovereign stress, and the repricing of risk, point in one direction: a sustained multi-year bull market in precious metals. Schiff believes that 2026 will be remembered as the year investors realized they could no longer rely on financial promises and began migrating back to tangible monetary assets. And the data from 2025 already shows that the shift is in motion. If you found this analysis valuable, please like the video, subscribe to the channel, and share your thoughts in the comments. Thank you for watching, and stay tuned for more deep dive coverage on gold, silver, and the changing global financial landscape.